Good evening, everyone. We will be getting started shortly. Thank you. Welcome to tonight's webinar, Tax Basics for Future Dentists. I'm Linda K. Tyler, the Director of Business Development for ASDA, and I am so glad that you were able to join us for a very informative and interactive presentation planned for you. During the presentation, we encourage you to submit questions via the Q&A feature. Our presenter is eager to answer your questions and help you understand more about taxes. We'd like to thank Panacea Financial as a sponsor of tonight's programming and for their continued support as the member benefit provider. I would now like to introduce our presenter, Mary Ann Chernoda. As head of corporate strategy, Mary Ann leverages deep knowledge of medical and dental practice operations, financial structures, and the real world challenges doctors face to inform strategy, guide product development, and support institutional decision making. As a healthcare industry leader, Mary Ann previously served as a partner at a top accounting firm. With more than 2 decades of experience in public accounting, specializing in physician and dentist, she now brings that expertise to support the distinctive mission of Panacea Financial. It is my pleasure and honor to welcome Mary Ann.
Oh, thank you so much, Linda, for the kind introduction. And thanks to all of you for wanting to be here tonight, to talk about taxes. I hope this to make taxes more approachable and more practical and even maybe a little more interesting to everybody. So our agenda for tonight includes basics of tax returns, types of wages, W-2, 1099, maximizing your pre-tax contributions. We'll touch on loan forgiveness. There are some new tax laws. It relates to taxability of some loan forgiveness. And then also, if there's time at the end, we can go over how the impact on like some state tax liability. I wanted to mention, I do have the question and answers, like the board. So I'll try to answer questions throughout the presentation, and we can kind of get all your questions answered. But if not, we can always talk later offline. So to start, we're actually going to, for our tax return basics, we're going to start with our first poll question. If all of you can see that. So how familiar are you with the 1040? What's a 1040? I filled one out before. I've used my parents' CPA. I would love to do tax if it wasn't for this. I think there's a few more seconds probably left on this. Oh, wow. Okay. So more than half, you don't actually know what the 1040 is. That's fine. And I'm happy to see that you filled one out before. And using your parents' CPA is also very good. And I'm hoping there's a fourth question sort of at the end of the poll where it says maybe you want to be a CPA instead of a dentist. So maybe we'll get a couple to change their mind and you'll want to do this too. So we'll see. Okay, here's a 1040. So now if you ever come across another sort of tax presentation, you can't say that you've never seen a 1040 because now I've shown you now page 1. So here on top of page 1, this is where your name goes and sort of your tax filing. So whether you're filing single or married, filing joint, and then you would list dependents down below. So that's the top part of the 1040. And then towards the bottom, this is where you would report your income and sort of other types of income. So the W-2 income, we'll go over that. And then also interest and dividends. Income goes here. And then on the next slide, so this is a 1099. So I talked about, we're going to talk about the difference between a 1099 and a W-2. So when you graduate, you'll have, the option, or you'll hear things like, you can work here, but we pay you 1099 independent contractor, or we pay you W-2. So this is what a 1099 looks like. You'll notice here, this is where the practice name would go, who's ever paying you, and then this is where your name would go, and then the total compensation would go in this box right here in box 1. This is important for future. So this is a W-2. So a W-2, again, the employer name where you're working, your name would go here. And then the wages, so this is what you would make gross. And then this is sort of what I'm sorry, would be taxable. And then this is what you're withholding. So again, in a 1099, you're not actually paying your own, you're not paying, or the employer's not paying taxes for you. So you have the option here to withhold. So we'll get into that in a little more detail. So here we have the comparison. So pros and cons, either 1099 or W-2. So that question comes up a lot. What do I do? Do I want to be a 1099 or W-2? Sometimes usually don't have a choice, but if it's a 1099, you're considered an independent contractor. And from here, you can deduct things, business related expenses. So anything basically for you to practice, think of it that way. So any equipment that you buy, dues that you might pay, conferences that aren't reimbursed, even accounting fees or legal fees, you can all deduct that against any 1099 income that you receive. Some minuses for 1099 is you are responsible for all of the payroll tax. You don't get to withhold. So instead of have tax withholdings, you have to make these quarterly estimated tax payments. So you have to keep track of that. Another thing, actually a pro of independent contractor, you would be able to maybe participate in a solo 401k or a SEP. And hang on, who fills the 1040? Okay. Or a SEP. So that would be if you have sort of income after the 1099 and all your expenses. Oh, sorry, there was a question there, but it looks like it got answered. So, okay, I'll move on. So the W-2, the employer pays half of the FICA of your FICA taxes, and you probably would have some benefits. So you may get health insurance, and they would put in for your 401k. In this case, though, as a W-2, you cannot deduct any work expenses, and sort of they control your schedule. So whenever, if they want you to work on a Saturday, a Friday night, they really control your schedule. Okay, so if you were a W-2 employee, like we just went over, you would report your income here on this first line, 1A. And if you're a 1099, your income would actually go here on line 10. Okay, here, I don't want to lose you, so I made these circles, but it actually, you would have to start from Schedule 1. You'd have to fill out Schedule 1. So here's Schedule 1, and then with a 1099, you also have to fill out a Schedule C. I'll go slow and I will go back to that again. So here's Schedule C. So again, if you get a 1099, which looks like this, your income would go in box 1, and you would have to fill out the Schedule C. So Schedule C, what happens here is your name gets prompted up here, and then you would start with income, and then you would also get to deduct expenses. So here's the income at the top. Income at the top, and then you would get to deduct expenses sort of below. Hang on, let me go back a slide. You would deduct expenses here in this area, the expenses that we just talked about. And then as I mentioned, once we take the income minus the expenses, then we have the total income, and that goes on Schedule 1, which I showed you goes back to the 1040. I have some questions here. Hang on, let me do this. Somebody had asked if you have a clinic and you have an option between a 1099 and a W-2, which is more beneficial to have. So it does depend. Sometimes with if you work at multiple clinics, some people like to do the 1099 because you also get certain other deductions like auto deductions, driving in between the clinics is also deductible. And it also sometimes with a 1099, the offers might be slightly better. But that um, it just depends. It kind of it's case by case. But sometimes the offices are willing to sort of pay more. So is 1099 legal for associates? Please explain why. Um, Tricky question. So I'm not a lawyer, but I'm a CPA. So the reason why some practices are able to pay 1099 versus some are not, if they control your schedule, it's one of the rules that you are technically an employee. But with a 1099, you have, as an employee, you can work at other different practices. So they oftentimes have you're able to like sort of go to different practices and you're working at different places. So you kind of have free reign to do and work wherever you want. So then there really isn't any restrictions on sort of what you're doing. So it kind of depends, again, from practice to practice. If it's legal, again, I can't comment on that, but that's how it normally works with really the income. Okay, so this is Schedule 1. So we talked about Schedule C and how it flows to this schedule. And then we will also next go through cancellation of debt. I kind of alluded it to in the agenda. So cancellation of debt is also a type of income now based on the new tax law as of January. And this is what a 1099-C form sort of looks like if there was sort of debt cancellation. You know what? Actually, we missed the poll question though. So let me take a step back and if we could go to poll question 2 or launch that.
Marianne, while we're waiting on the poll question,
Yes.
did you want to explain or are you going to explain the difference between the two schedules?
Um, the 1099 or W-2 or the
Y-
Schedule
The
C.
schedules that the schedule Cs that you were just referring to.
Hang on, I could go back. So there's only one Schedule C, right? So a Schedule C is filled out usually, again, when you get a 1099. So it's one schedule, it's one page. This is the top of the page, and this is sort of the second half. So when you receive a 1099, it only goes on Schedule C when it's in your personal name. Um, if you end up incorporating, that 1099 would get issued to your corporation's EIN, and that would go on a totally different tax return. I don't know if that was the other question. Oh, here is the poll question number 2. So here we were just talking about total household debt. So that would include everything, mortgage debt, student debt, credit card debt. Um, how much would that amount to after you graduate? Probably a few more seconds on this one. Okay. All right. So 31%, you're sort of right in the middle there. That's what we um, usually see. So I wanted to mention, though, going into this next topic, as we said, the tax law did change as to cancellation of debt. We went over that. So, oh, I don't know how many of you had joined the previous presentation where they went over the basic ways to pay student loan debt back. So formally, pre-1126, the loans were not taxable if it was forgiven. So now, as of 1/1/26, with the new tax law, unfortunately, the income-driven repayment, that portion would now be taxable. So the PSLF, the Public Service Loan Forgiveness Program, that is still considered non-taxable, so it's not taxable. But if you do have any debt forgiven through the income-driven repayment, you would be getting one of these 1099-Cs as we talked about. So that would be included as income. So it was new tax law and I definitely wanted to bring it up, and we're going to go over it next. So again, it was tax-free previously, and now starting in 2026, it's no longer exempt from income. One thing, though, that would be sort of something to consider is you could refinance the loan as an alternative. So by replacing that type of loan, you could potentially pay it off at a lower rate, and might be able to pay it off faster. Um, Another way to sort of tackle this loan repayment is that some people file sort of their tax returns before their taxable income goes up. And this kind of helps to help the payment sort of stay lower, because once you report your income, you would be keeping right that same payment for 12 months. And another idea would be also to file like a tax extension. So some we have seen where they file a tax extension where then they can use their most recent sort of lower income before graduation. We have also seen situations where you can file a married filing separate return. And in that case, the income would also be lower. You would lose some tax benefits. We'll go over a tax table later. You might lose some tax benefits and a couple tax credits. But with the payment going forward, it often outweighs that. Um, so also as it impacts sort of the state tax liability, as I had mentioned, with the state tax liability, 9 of the states is actually, or there's actually no state tax income, so the loan is actually tax-free. Where it leaves the 21 states that may or may not, it may or may not be tax-free. So it just depends what state you live in. Again, at the end of the presentation, I have the real detail as it relates to which ones are tax-free and which ones sort of are in the middle there. So here is an example, a specific example of how that works. So before January 1st of 26, what would happen is, let's say you made 50,000 of gross income. So before you'd make the 50,000 of gross income, if you had any student loan forgiveness, it really wouldn't count. But now under the new tax law, you would have the 50,000 of gross income. Then we would have to add that in just this example, 40,000 of student loan forgiveness. So keep in mind that your gross income would now then be actually about 90,000. So it would bring you in a higher tax bracket. Which if you kind of Google it or you look online, they're referring it to sort of like a tax bomb or a surprise because, again, it wasn't taxable in the past and now it will be. This is what a tax table looks like. So let me go back. So in this example, it kind of shows, as I had mentioned, 50,000 in gross income. It now goes up to about 90,000. So before you would owe approximately about 5,900 in taxable income, and now that goes up because of the taxability of the loan. Your tax liability would then go up to about 8,800. And how that gets calculated is this is a tax bracket. So I know many of you probably, if you haven't seen a 1040, you probably haven't looked at what tax brackets look like. The tax brackets, they change. They change every year. So we have a graduated scale where this is the 2025 tax brackets. So you have a single sort of row, married filing joint, head of household. There's also married filing separate tables. So really, if you say, okay, I'm in the 24% tax bracket, you're actually not taxed, right? 24% on each dollar that you make. So let's just take the single filer column for an example as we talk through this. So under single filer from 0 to 11,925, that's taxed at 10%. Then from 11,925 to 48,475, that's taxed at 12%. Then anything over 48,475, that's taxed at 22%. So that's what I was mentioning in my previous example. It would keep you really, had the tax law not changed, you would just still be in this 12% tax bracket. But because of the loan forgiveness now being taxable, it brings you that portion of it into really the 2020 or the 22 tax bracket. Um, so there are opportunities. I mean, the IRS, they do let you automatically set up a payment plan online if the balance of the tax due is about 50,000 or less. But as you sort of, if you have an installment agreement, there are still sort of penalties and interest. I'm sorry if I'm going a little bit fast. This will be recorded and you will be able to go back. and review this. So again, here, this is really the detail as far as taxable income that we went over. So again, here, right, 10% is taxed at the first rate, and then it's really a graduated scale. As it relates to state taxes are a whole different ball of wax. Each state has different tax brackets. Some are graduated, some are a flat rate, some are 0%. The recording, I believe you would have to log in, and you would be able to access that. Okay. So that we went over then, sorry, the student loan forgiveness and how that's taxable. Another question that I get a lot is also student loan interest deduction. So how do I deduct my student loan interest that I'm paying? So that would get deducted here on Schedule 1, and it's here on line 21. For student loan interest deduction, though, I wanted to point out, so you get up to 2,500 interest that you get to deduct for student loan interest. However, this also depends on your adjusted gross income. So adjusted gross income here, I highlighted in 11A on this line. Keep in mind, every year the tax sort of the forms, they change a little bit. So not every year it'll be line 11.9, but adjusted gross income for 2025 is line 11A. You check that line, and if your adjusted gross income is 85,000, you would actually phase out and you wouldn't get that 2,500 student loan interest deduction. And then also if you hit up to 175,000 married filing joint, that you would also then phase out. So keep that in mind as well. Oh, we're already poll question 3. If somebody would want to launch that. Let me check the questions while we're doing that. Hang on. Oh, pace of the presentation, sorry. Too fast, too slow, just right, too technical. I gave you a headache. Do you want to be an accountant? Somebody had written earlier, sorry, while this is going, about should I be a 1099 or a W-2 at first? It might be easier as a new grad just to keep track of taxes and everything to take or to be a W-2. If you plan on working maybe at different practices, right, you could be a 1099, so you're sort of a mini business all in itself, and you can take various deductions against that 1099, including those automobile deductions that you sort of were asking in the chat. As far as recommending a CPA and trying to start working with one, I mean, whatever your comfortability is. I'm glad that you think the pace is okay. I'm hoping really the pictures and the examples are helping because I know this is a lot. And again, when we started, a lot of you have not seen a 1040, so I'm trying to go through it pretty slowly. Yeah, I mean, making or starting a relationship with a CPA, I think, is helpful. And early on, if you want, I wouldn't wait till the last minute because CPAs get very busy during tax time. As it relates to a student loan overseas bank. So usually when you get student loan interest that is deductible on a US tax return, you will get a tax form. I didn't snap a picture or a snippet of what that looks like, but I'm not sure if this bank that you're referring to will give you a tax form that you can then claim on your US tax return. Okay. I've cleared the questions. So that was polling question 3. Okay, we're going to go over standard deduction and itemized deduction. I think I know you've been wanting to know. So people often say, do I take a standard deduction? Do I itemize? So usually it depends, right? Everyone's tax situation is very different. This is where the standard deduction gets taken on line 12. And then these are the standard deductions here on the left. So every year the standard deduction is different. For a married filing joint return, it's 31,500. Head of household, it's 23,625. For single, it's about 15,000. So what happens in itemized versus standard, you usually want to calculate both. So the standard deduction, here are the amounts, and then the itemized deductions, it includes medical and dental expenses. There's certain like real estate and state tax paid, mortgage interest, and charitable deductions. So one exciting thing on a plus side of what happened with the new tax law is that state taxes and real estate taxes, those were both limited at one point to only $10,000. So this year it went up to 40,000. So people that might have not been itemizing in the past will now get the opportunity to itemize because there are a lot of states that are really high in real estate taxes and state taxes. So now that the max is 40,000, a lot of people will then be able to take advantage of really these itemized deductions. So again, here you would compute a standard deduction or the itemized deduction as we went over. You see which one's higher. And then we compute taxable income and tax per that tax table that we went over. And then in the end, we compute sort of total tax, right? Okay. Here are the tax brackets again, just to remind you, these change every year. So next year for 2026, when you file your taxes for 26, which is in 27, there'll be a new tax table. So these will be current since right now we're filing 25 tax returns. Okay, so Schedule 3 is a whole different schedule. And I wanted to point this out because after you compute tax, there are also certain deductions that you can take after you compute tax, which are also very exciting. So one deduction would be a lifetime learning credit. Sometimes this is missed because you can take this credit and you would qualify because it's eligible not just for undergrad or grad students, it's students such as yourself, where you could keep taking this lifetime learning credit. So after tax is computed, once again, as I mentioned, you can deduct the lifetime learning credit against that tax amount that's computed. And then that gets to your total tax. And I know you're wondering, and this is still sort of page 2 of the tax return, if you can believe it, of the 1040. So what happens next on the 1040 is after we compute this total tax, here we have our federal income tax withheld, and then estimated taxes, and then sort of the total payments, and then what you get as a refund. So this is where it happens where everyone says, okay, my neighbor, my friend, they have, a $10,000 refund. Why did they get 10,000 and I only have 5 or even nothing? So there really isn't necessarily free money. So what ends up happening is after you really compute your total tax, we look at sort of what you've already withheld throughout the year, right, on the W-2 that we went over earlier. So you have total tax minus what you've withheld. Sometimes you have to pay those estimated taxes, like I mentioned. So then you would subtract that also from total tax. So that's really what gets you if you have a refund or if you actually owe. So really you maybe paid in too much or too little, and that's why you either owe or you get a refund. So it's really not free money, and the one that, got a $10,000 refund isn't necessarily luckier than you are. So that's the secret behind that. So again, here, as I mentioned, the W-2, this is where that federal tax comes in, right? So again, you have your wages and then your withholding. So you get to choose what you want to withhold throughout the year. And here I talked kind of conceptually. So again, just to go through it, total tax and then what you withheld throughout the year in line 25. And then it goes down and it computes your total payments, right? So it keeps track of what you've been paying throughout the year after your total tax. Okay, so we made it to poll question 4. If we want to launch that next. So while that is launching, what keeps you up at night? Somebody asked here, as an associate dentist, what can you go ahead and deduct against that? So you want to think of it as to be a dentist and to practice, what types of things are really coming out of my pocket, right, to do this role, to do this job. So certain things, right, would be equipment, dues, any subscriptions. I don't, sometimes if you need a computer or really sort of your phone, again, legal, accounting fees, supplies. So anything really out of pocket, you can deduct against the 1099 income. Oops. Let's see. Not sure. There's probably a few seconds left too on this end as far as what keeps you up at night. Hope it's not filling out your tax return. Oh, two of you said it was. Okay, that's all right. I thought it would be easier. And yep, it's very interesting. So, okay, great. I'm interested to see what other things would keep you up at night, but I can't see anybody on this presentation, so I cannot ask. So let's see. So we're back on the tax return. So the next thing we're going to talk about is we talked about wages. So this wage number here, box one, I always call it box one income. On wages, this is what you put on your tax return, right? Page one of the 1040. There's also ways we can lower this number. So certain ways we can lower this box one income, which then becomes taxable. Are some ideas here. So you want to take advantage of any pre-tax contributions when you're an employee. So sometimes pre-tax contributions might be a health savings account. You can put away in a 401k. So let's say you're making 50,000 gross, and you can put away in a 401k and you put about 10,000 away, then your that gross income then becomes 40,000. So really now you're paying tax on 40,000 instead of really the 50 that you make, and then you're putting 10 away. So these are the limits. Now, if you're looking at sort of these pre-tax accounts, so 401k, if you're under 50, you can put up to 24,500. The health savings account that I mentioned, if you're under 50, these are the limits. And then you can also, depending on your income, you can also you can contribute to a traditional IRA, and that is also deductible. Okay, so we went over again some of the pre-tax deductions that you can take to really lower that box one income. And then this is the W-2 again. So just to remind you, so let's say this was 50,000 here in box one. You can then lower by choosing things with your employer to pick that are pre-tax. Sometimes different practices might even have like a child care pre-tax sort of flex account. It just depends. So you might want to ask like what pre-tax sort of programs do you have and what can I deduct? So again, the bracket, so that really impacts your bracket because again, if you're in this $48,000 bracket as a single person, but then you participated in maybe 10,000 of 401k, it really brings you down next to maybe the 12% bracket. So it is very helpful to really look at a lot of those sort of pre-tax programs as an employee to help bring that down. Okay, let's check if there's any questions. Nope, okay. Okay. We actually did make it to the state tax liability section. So state tax liability, as we had mentioned with the loan forgiveness, all the states are really very different. So there are about 9 states that don't have any state tax. So the loan forgiveness is actually tax-free. And then the 20 states that just conform to federal rules, which means that they just take the AGI of whatever you have in federal, and that's what you have as far as taxability. And then the remaining states, it's kind of it's a Mod Podge. So they all have different rules, the other remaining states, as far as what will happen next. So here's sort of a brief summary. So the 9 states that have no state income tax, so the loan forgiveness we talked about earlier would be tax-free, would be Alaska, Florida, Nevada, Washington, Wyoming, right? So this would be great because it really lowers the student loan forgiveness, and there's no personal tax in those states. The 20 states that actually conform with the federal tax rules, so they're listed here. So Illinois, Kansas, Louisiana, Ohio, Oklahoma. So again, just the easy, when we talked about adjusted gross income, right? So it takes the calculation from the federal sort of taxable income or adjusted gross income, and then it sort of calculates what you owe for that state. So that's kind of a high level explanation, but that's how it gets impacted for those 20 states. And then the remaining states here, so three of the states, they base it on the federal definition of taxable income instead of adjusted gross income, right, as you can see here. So Colorado, North Dakota, and Oregon. And then now the other three states, they also base that on AGI as of a specific date, maybe not necessarily what's on the tax return. And then the other states also have sort of another specific special definition. Okay, so should we all move to Texas is the other question. I mean, there are other states we can choose from based on the chart, right? The other eight. So I don't know. I don't have any more poll questions for that one, but um, so state taxes, somebody had asked if you moved mid-year. What ends up happening is that you would file a part year tax return. So the dates would say, January through June, I lived in Texas, so there would be no state tax for that for the first 6 months. And then July through December, I lived in New York. And then you would file sort of this part year state tax return for the two states. You have to be very careful because when I was practicing, I did see tax notices. So there are some states, for example, I had somebody living actually in Texas, and then they moved from Texas to Illinois, and then from Illinois back to Texas. And actually, Illinois sent them a tax notice when they moved back to Texas just to evidence that they actually moved out of the state. Alex, actually, okay, so there's also when to refinance the private loan. We would have to kind of defer to our banker, so we can kind of take that one offline for you. Were there any other questions that anyone had? I'm surprised that, that nobody has any additional questions on taxes or maybe want to volunteer at a tax place.
You were just very thorough
Oh, I was.
in your presentation.
Yeah, there are, yeah, I didn't know if anyone else wanted LLC. So, okay, we could go over that. So somebody's asking about setting up an LLC. So when you set up an LLC, hang on, I'm going to go back actually so an LLC, you could set it up in a few different ways. So an LLC, let me go back to Schedule C for us. There's a couple of things. So when you're an LLC and when you're a corp, you can actually elect, this is very confusing, but you can elect to be a single member LLC, or you can have a partner, which then that LLC, if you have a partner, you would have to file a separate tax return. And then, or you can also be an S corp. So you could be an LLC and then you would elect to be an S corporation. So there are no slides for this at the moment, but I can just tell you. So there are different types of corporations. So there's a C corp, there's an S corp, and then you can also be an LLC. Again, as an LLC, you can elect to be an S corp or a single member LLC. If you were a single member LLC, you would just still file the Schedule C, but you would have a separate EIN. Oh, this is actually a good point. So an EIN is this employer identification number. So if you see here on Schedule C in the section D, this is EIN. So versus if you were just a 1099, your social security number would just go up here. So as an EIN, you have a totally separate tax ID. You would incorporate it as an LLC. You can even say a different name, I'm ABC Dental. And then you would get assigned an EIN by the IRS, and you would file, if you were single member LLC or even a separate return, you would then file under that name with the EIN here. And how would filing an LLC impact your taxes? So if you were a single member LLC, it would again be the same way on the Schedule C. So you would just put the name of your LLC up here, income and expenses, and in sort of Section D, that's where you put the EIN. So it's sort of the same on an LLC. And then if you were a separate tax return, an LLC, you would get a K1. So we didn't go over K1s, but you would get another tax form, which you would then report as income. When would you hopefully that answered your question. Feel free to sort of chat me if you needed sort of more information. So now the next question came in and it talked about when would you consider filing separately? At first, you're borrowing a loan. Okay, so you would consider filing separate when you work with a CPA or somebody. Usually, you kind of want them to run that scenario every year, even. So even when you're both married, even 3 years out of school, sometimes it does still make sense, depending on the income of you or your spouse. Because again, with the different tax brackets, depending on how much each of you make, it would definitely impact sort of giving up maybe the tax deductions and credits in order to really get that future payment lower. Any other questions?
Doesn't look like we have any more in the queue for you, Marianne.
Oh, okay. So I mean, we had over 50 slides, but
I know.
I thought maybe, but I'm glad that no one else wants to be a CPA. That's okay. But I'm glad that now in the future you can't say you have never seen a 1040 or you don't know what a W-2 is or a 1099. I mean, I hope I give you more confidence in going through and after graduation, really deciding and talking to people and being able to say, oh, okay, I know the difference now. And also a 1099, making those estimates are really important. I find that sometimes after graduation, you get a 1099 and then come tax filing time, you haven't actually paid any estimates in. Because again, keep in mind that no taxes are being paid on your behalf when you get a 1099. So
Mhm.
it's another mistake that sometimes we see in filing your taxes because then you'll owe, 10,000, 20,000 because you weren't making those payments along the way.
So if there are no other question, and it doesn't look like it, I just want to thank you on behalf of ASDA, and I want to thank all the students. Oh, before I wrap this up, it looks like, do you recommend paying quarterly
Yes,
for
for sure.
1099s?
Yep, you need to pay
Okay.
quarterly taxes for 1099s. You don't want to be caught with sort of this tax due at the end. It's very stressful if you owe a lot of tax and you didn't know it and you don't have it saved. After graduation, there's a lot of other things you want to spend your money on. So,
Mhm.
um, the taxes you'd want to save for, but you definitely don't want sort of a tax surprise later on.
So thank you, Marianne, for that. Thank you for answering that last question too. And Panacea Financial, we can't thank you enough. We appreciate your continued support of ASDA and the member benefits program, being a member benefits program provider. More information can be found about Panacea on the website under our deals and offers. And I know some of you asked about the recording. If you'd like to review the webinar again, it will be posted in 1 week on ASDA's YouTube channel. And then we're also going to save it on the webinar directory. That's at asdanet.org, and it's under the Program and Events Webinars tab. We will also send you a reminder when the webinar is available, so you will get a notice. And then, as Marianne was saying, if there's other questions that didn't get answered tonight, we'll make sure that she get them and she'll follow up with you thereafter. So thank you all for joining us tonight, and you have a wonderful evening.